Hello, hello. Hey, hey, hey. How you doing? If you're in the house, you already know what to do. Drop a comment. Let me know you're here. We got some early attendees. So shout out to Ignacio for dropping some comments. Mr. Rick and Sherry Lee, God bless you. First comments in the house. Happy to have you. Shannon, hello, just tuned in. How you doing? I've got some exciting news to share with you, okay? But before I share the news, I'd like to introduce myself and welcome all the brand new subscribers to my YouTube channel. If this is your very first live stream in attendance, please let us know so that my veteran live streamers and my loyal clients, loyal subscribers can welcome you into the kingdom properly, okay? My name is Denzel Rodriguez, your personal finance geek of the 21st century, and today we're going to be discussing velocity banking and infinite banking combined. On this YouTube channel, I primarily cover and teach the velocity banking concept, the infinite banking concept, and kingdom authority, helping moms achieve financial freedom by becoming debt-free or debt-leveraged, either or, creating a 10x strategy to live the lifestyle they desire, to be a mom and a woman at the same time and not feel guilty about being a mom, to be able to have a business, have a life, have kids, have the spouse, have the house, and maintain it all with full confidence and authority. Do you know what I mean? Okay, that is my mission here on planet Earth. So for the time being, we're gonna have fun executing that purpose here on planet Earth with your help, being in attendance, being a loyal subscriber, a giver, a client, a kingdom-oriented individual, giving beyond measure, being able to be blessed, live in abundance, learn some new things, and operate in your original intent, your original purpose in life. So let's dive right into it. We got 42 people in the house and climbing. I want to welcome everybody again. The first piece of news that I'd like to share with you is your one and only finance geek has officially been trademarked, okay? So I have a previous video, okay, and let's see if you can see that. Yeah, zoom in. Okay, so this right here is my logo, Denzel Rodriguez, the finance geek. I got the logo trademarked, okay? Prior to that, I have a video in I have a playlist called Channel Progression, and there's a video where I trademarked the words, the finance geek. So that's like my brand, so I trademarked that. My logo is my name, little simple box, finance geek, and also got my face trademarked, okay? So you can see that, all right? I got my face trademarked. Let's see if you can see it better this way. Oh yeah, that's much better. So I got my face trademarked. Y'all see that? Most people are familiar with it by now. If you've bought a product from me, you've seen that logo. So this is a huge, huge achievement. Now I can put a nice little R next to my logos on my website, everywhere. My videos, everything. So we've solidified this kingdom in terms of legally trademarking myself, owning the name, owning the domain. You know, nobody can use it. Nobody can use my face to profit, right? And so I want to get your feedback. When you see that logo, my face, tell me a few things, one or two things that comes to mind when you see my brand, when you land on my YouTube channel. If you're a client of mine, what do you see? If you're a brand new person, brand new subscriber, or you're a longtime client, what do you see from the first time seeing me up until this point? Drop some comments. Let me know how you feel. What has been some of the biggest takeaways that you've gotten being in my kingdom and seeing all the progression, the results. Please comment. Let me see. I wanna get some feedback here. I wanna learn, see where I can improve and how I can continuously, get better at what I do. So let's see what we got here. Let me scroll up. Hi, Denzel. Hello, hello. Hello, everyone. Hello from Key West. How you doing? Ida from Dallas. Richard. Hello, Denzel. Nice to meet you in the house. Pleasure. Good evening, everyone. God bless. Oh, we got first live streamer. Please welcome them. Hello from North Carolina. Glad able to tune in. Cool. Tuning in. First time. Cool, cool. Congratulations on your trademark. Thank you, thank you, thank you, thank you. We got my one and only woman in the house. Ooh, trademarked your face. Sure did. Congratulations. Well done, sir. Justin, trademarked the beard too. Yes, I did. Yes, I did. I trademarked it. Yes, I did. Okay, so above quality information and passion. Appreciate that. Trustworthy. Congratulations. Savior of financial debts. Love it. Honesty. I feel safe. Financial freedom. Joel says hello. Okay, great. Awesome. I appreciate that feedback. This helps me improve. Remember, I'm 25 years old. I got a lot to learn, but I got even more to give. So I'm here to really be a steward, a student as well. Tony says, congratulations on well-earned trademark. Face matches well with Finance Geek. It is who you are. Allison says, kingdom. Pride in what you do. You don't hide behind anything. You put yourself out there. Thank you, thank you. All right. So now, let's dive into tonight's lesson. I'm going to try to go fast. It's not of my character, typically. I'm going to try and be effective. Okay, that's the goal. I want to be effective. I want to stay on task. I'm going to share with you a real-life case study, client of mine. I'm going to take you through the velocity banking, and then we're going to introduce infinite banking. I'm basically just going to share with you their journey from first connecting with me, finding my YouTube channel, becoming a client, and then 2021, as of today, what they're working on. All right, so let's dive into it. Let's have some fun. Let's share the details. So we have a client here on the board. We got a husband and wife. I typically work with the wife is usually the leader in the conversations. I believe it's the wife that originally found me. But what's nice is husband and wife are always together on every one of the phone calls that I've had with them from very first time of signing up. So some things that I want to share that are some fun facts about this particular client is they're a Patreon giver. So they have sowed seed into my kingdom multiple times. They became a lifetime client. So not only did they give money to my kingdom to help me grow this YouTube channel from an early stage, but they also became a client. They enrolled. They are also a policy holder. So they bought a high cash value life insurance policy designed for the infinite banking concept. And we are approaching a 3-year relationship. They originally found me back in late 2018, and then they became a client in 2019, because in 2019, that's when I actually released my first coaching consulting service. They came to me with, a lot of money in debt. And what I wanted to do, on my notes here real quick so I don't forget, I wanted to look at one of their first spreadsheets they've ever sent me. I wanted to make sure I at least show you that, because this couple, the amount of debt they wiped out in such a short period of time was insane. So they came to me with student loan debt, credit card debt, car debt, mortgage debt when we first started talking, and as of today, 2021, they've been able to, using the velocity banking concept, they've wiped out all of their debts except for the primary mortgage. That's the only thing they have left. So this debt right here, $210,000 at 3.25%, that's their mortgage. That's the only debt that they have as of today. Okay, so those are some fun facts. Diving into the numbers, they currently make, as of 2021, $8,000 a month. Their expenses are $6,000. Like I said, debt $210,000, just a mortgage. Their cash flow is $2,000. They have a home equity line of credit in the second position for $25,000 is the credit limit at a 5.5% interest rate. They have $12,000 cash on hand. They have a Mass Mutual policy, which got established in 2019. So they've already funded it twice so far. They've already dumped money in twice. And their anniversary date is coming up on March 27th. So they're about to max fund their policy for a third time. So they went with Mass Mutual. We did it under wife. Wife was younger and healthier. Unfortunately, we tried on husband. Husband got denied off health, but luckily he already had a whole life, a cash value life insurance policy in place. So we made sure not to kill that policy. We kept it in force, and it has some cash value built up. It wasn't designed for infinite banking, so it doesn't have nearly as much cash value as wife's, but that is okay. So we're using wife to practice the infinite banking concept. Like I said, it was based off age, health, and finances, and those three matched up better in her favor, which was good. The funding amount, the projected funding amount that we started with was $16,500 a year. The base premium is $1,911.50. Total death benefit $425,000, and the MEC limit, which stands for Modified Endowment Contract, is at $20,001.96. So, as you can see, this is not quite a 90-10 split design policy, more like a 87-13 or 88-12 split, where when we were speaking and originally mapping this out, they had $16,500 of capital to start the policy with while they were doing velocity banking, wiping out debt. So they were combining the two together. At first, it was just velocity banking, and then we implemented infinite banking later into 2019, and kind of kept the ball running since. So when they started with 16.5, they wanted a little bit of extra space. They wanted the ability to put in a little more than the 16.5. So the base premium is $1,911.50. So that means that we're able to put in, $19,000 and some change each and every year for a period of time, not forever, but for a period of time. Okay, so overinflate the MEC, $20,000, to allow the individual to make changes to the policy. And one of the things that we did was we had backdated the policy, I believe. So it got funded later in 2019, but then in 2020, the anniversary date was earlier. It wasn't a full 12 months. So that's what that means. When you backdate a policy, you're essentially, your anniversary date is going to be your birthday. So if your birthday is in March, but you start a policy in, say, September, your anniversary date is not going to be September the following year. It's going to be March of 2020 or 2021, 2022, like in that case. So we did some backdating, and the first year was 16.5. The second year she dumped like 10, and then like added more money later on. So Mass Mutual was a little bit flexible in that ability to add funds. Guardian is a little more flexible in terms of adding money at leisure whenever you want. We kind of had to fill out some paperwork and make some changes in order to allow us to add funds when we wanted to. But now they're at a point where for 2021, they're actually going to, I believe, they're going to fund 20,000 this year using Velocity Banking and Infinite Banking combined together. So we'll see how that goes. And so to kind of break that down, the $16,500 number literally came from the 66% rule of how we borrow from our debt tool. So when we're doing Velocity Banking with the HELOC, 25K times that by 66% is 16.5. So this is how they were chunking, like literally from when we first started working together, when we had a previous debt tool, then upgrading. They've always been using the 66% rule, pretty conservative, never really went above it. They've went from paying off debt to running expenses to paying off debt to funding a policy and all this stuff. So they used a chunk to initially start the policy, then they borrowed out of the policy to pay off debt. So as of 2021, they do have loans in the policy. They're getting ready to dump anywhere between as low as 16.5 or as high as 20,000. The reason why I say 20,000 is they have this $12,000 cash on hand, and at the moment, as of today, we're in March 2021, they are at a zero balance on their HELOC. So if I have $12,000 cash on hand, to get to 20K, I only need an additional 8. So they might leverage about 8K chunk from the HELOC to get to that 20. I think they might do 18, 19. We didn't really solidify a number, but I think they're going to close in on 20. We'll see. So if they do 20, they'll be borrowing 8. If they do, 19, it'll be 7. You know what I mean? So they're using their cash on hand capital, sending it to their cash value life insurance policy so that that money can grow at a tax-free compounded rate, unaffected by the marketplace. And then they're going to pull money from that to continue to either pay off debt, or they want to now 10x. Okay? So this is about a typical ideal financial situation when I'm working with my clients. Is it kind of starts off like this. They land on my YouTube channel coming from this kind of mindset. Debt snowball, Dave Ramsey, frugal, minimalize, don't use debt, avoid debt like the plague. They come to realize, oh, you know what, this is taking too long. It's not as effective. I'm not happy in the process. There's got to be a better way. So when that hit, they landed on my channel. One of the first things they saw was Velocity Banking. So took them from debt snowball to Velocity Banking, right? They're paying off debt. They're going faster than debt snowball. This is building momentum. They're building their personal credit score up. They're wiping out debts. They're releasing stress. Things are going well. Okay, great. They're now expanding their mindset. They're becoming open-minded to the infinite banking concept. So now they spend time, they research, they watch videos, they look at the good, the bad, the ugly, they put it all together. They say, Denzel, I'm ready to go. So now they've got Velocity Banking going. Then they start the policy. When we combine Velocity Banking, essentially what's happening is instead of making your chunks directly at debt, when you hit a point where you have enough cash flow coming in, good income, you've wiped out plenty of bad debts, consumer debts, and you're just down to like maybe student loans and a mortgage in some cases, and you've got extra capital, you're willing to pull from different assets, you can then create a strategy where you chunk at a policy where you max fund it with one lump sum payment. And the ideal strategy is to chunk a decent amount of money to cover our cost of insurance, the early cost of fees in these policies, because they can be quite expensive in the first few years. It takes time for the policy to really take off and do what it's designed to do. So we want to be able to have enough capital to really, cause some damage, or else it's better to stay with, say, debt snowball velocity banking and keep creating momentum with that. You don't want to slow yourself down trying to force infinite banking to work in your favor. Understand? So they understood that, they educated themselves, they watched tons of videos, they, like I said, the good, the bad, the ugly, put it all together. It's got a policy in place. They got one. They're funding a policy. They're getting more results. They now have an asset that will perpetuate or help perpetuate their kingdom and legacy. They've got 3 children, if I'm not mistaken, and they're establishing their kingdom values, morals, ethics before they leave planet Earth. So they've got this great asset that's going to protect them. They've got a great concept, velocity banking. They've got all their prior knowledge of finance. They've mixed it all together. And then they're like, Then they see one of my 10x videos where I promote expansion and scale and, multiplying income, creating value in the marketplace and getting paid significantly more for your time for the same amount of work involved. Working smarter, not harder. Transitioning from working for someone to working for yourself. So now I'm planting those seeds, right? So now they're at this point. This is like the final stage, in my opinion, of how I work with my clients. I meet you where you're at. I introduce a pretty cool concept, velocity banking. It can improve your personal credit. It can show you how to leverage debt. It can show you how to use debt, not have fear over debt. Okay, how to borrow from Peter to pay Paul and pay nothing in interest, offset your cost of borrowing, accelerate your debt. And then I show you another cool concept, infinite banking, shows you how to accelerate your savings, not investing, just accelerate your savings, preserve money, perpetuate your kingdom. Then we step into 10x, where it's like, hey, what if in the next 5 to 7 years, what if we went from $8,000 a month to $80,000 a month? What could that do for your life? What could that do if all I did was add a zero over the next 5 to 7 years? What could that do for your life? What could that, reveal about you as a human being, as a person, as a business owner, as an entrepreneur, as a mom, as a dad, as a brother, a sister? What can that reveal in your character and your behavior, how you operate, if we went from 8,000 to 80,000? So here I am planting that seed now, and now we're at that stage where we can take both these concepts, velocity banking, infinite banking, instead of just paying off debt. Here's where the shift occurs. We now go from, hey, paying off debt is actually not that smart under the current environment, financial system that we live in. Unfortunately, paying off debt can actually hurt our financial freedom pathway in many cases. It can delay our progress. Now, that is an opinion. This is not a fact of what I'm saying. What I just said is an opinion, right? I just said paying off debt is not smart. But Denzel, most of your channel is talking about paying off debt. Yes, I know. It's a matter of meeting people where they're at. Okay? We've got good debt and we've got bad debt. Bad debt takes our cash flow, hinders us from financial freedom and financial success. Good debt creates cash flow, gives us tax write-offs, multiplies, expands our business opportunities, relationships, networks, puts us in the room, creates relationships that we never thought could be, okay? Catapults us to the next level. Well, but isn't debt the same? I've always been told that debt is debt and debt is debt and debt is bad, and if you own debt, you're a slave and all this stuff. Well, wait a minute. Your country that you are a citizen in, the US, has over $26 trillion in debt. There's an issue there. If your country is in debt, you, my friend, as a US citizen, you are in debt. So even when you get out of debt, you're still in debt, technically speaking, because every dollar you have came from debt. It came from someone else's debt. All money at this point is debt. Now it's a matter of what debts do I need to get rid of and what debts do I need to accumulate. So in this case, they have a mortgage at $210,000 is the balance, 3.25% is the interest rate. The question becomes, I'm getting charged 3.25% on this mortgage. Can I go earn more than 3.25% on my money? Can I 10x that return if I took these dollars that I would have thrown at the mortgage? Can I throw it at a business? Can I throw it at my purpose in life? Can I obtain a new skill in the marketplace? Get a return on those investment dollars that I'm putting in myself? And now instead of saving interest and saving money, we're making money. We now get to ask the question, do I want to save $10,000 or do I want to make $10,000? Which one is faster? In my opinion, I think it's a hell of a lot easier and faster to make $10,000 than it is to save $10,000. Because here's the issue. Even if I save $10,000 paying off this mortgage via the interest, the money that I threw in to that, its purchasing power has decreased by probably 20% over the last 12 months because they just printed over $6 trillion in the last 12 months. So those same dollars are now worth less. They're worth less, literally. So when I throw my 10 grand into my mortgage, that money is gone. The only way to access it is through what? Debt, equity, right? And if I need it to, say, pay a bill or refinance or pay an expense, those dollars are worth less when I go to use it. So this becomes a dilemma. This is not so simple anymore. It's not so straightforward. It becomes, okay, is it possible for me to service debt, manage debt, operate this debt over here, start a business over here from scratch, create income, and to really measure the success of this is you create a timeline, call it 5 to 7 years. Call it 5 to 7 years. We do the math on debt snowball and velocity banking and infinite banking. We say, okay, in order to pay off $210,000 using any of these three concepts or all of them put together, we'll be debt-free in, say, 4 years, right? If we just pay off debt, we'll be debt-free in 4 years. Well, in those same 4 years, what if we 10x'd? We 10x'd our income, and at year 3.75, I could just write a check, pay off all the debt, pay off the whole entire mortgage. Who went faster? This guy, this option, the 10x option. I went faster. 3.75. Is there risk? Yes. And that is the real decision maker, right? These concepts are safe. Velocity banking, safe. Infinite banking, safe. The most safest one is right here, debt snowball. That's probably the safest concept. You're probably not going to have much financially, but it's safe. It's guaranteed. Velocity banking does have some inherent risk because you are leveraging debt, other people's money. Okay? Infinite banking reduces the risk of using other people's money. You're now becoming your own banker, so you're using and financing your own dollars. But with this, you lose this. You lose time. With IBC, you can lose time in the beginning years if you don't have, say, multiple streams of income or the desired amount of money that you want to make. So if I was making $80K a year, this is not going to slow me down if I go buy a policy, right? So time, that's not going to slow me down. It's when I'm making $8,000, $6,000, $5,000, $4,000 a month, $3,000 a month, that's when infinite banking can slow me down because I haven't yet produced a strategy to multiply money. Most people want to grow their dollars. I want to multiply it. Multiplication is faster than growth. Would you rather have a steady 8% rate of return, ROR? Would you rather have that? It's guaranteed. Or would you rather multiply 10x? There's some risk. It's going to take time. But I mean, the vast difference, multiply 10x over growth. I have no issue with this right here. I love this, by the way. It's safe, it's guaranteed, it's straight to the point. I love that, but I need this to fund that and to fund everything else in my financial structure. I need a money machine. I need a money-making machine. Okay? If I create a money-making machine for the time that I'm here on planet Earth, and then move those dollars into different assets that continue to compound the money, then anything I add in my finances is just cherry on top. So if I add velocity banking, that's cherry on top. If I add infinite banking, that's cherry on top. So really, 10x over everything, but I understand that it's not always the right timing for people. They're not ready to hear that information. So that's why I just try to meet you where you're at. I want this. I need wins. I need early wins, momentum, and speed. And I take you through a nice little process. And then this is the end. You get to hear, this is a fun place to be, because now we're not talking about, oh, you know, how do I make a chunk? And how do I do this? And how do I take my money from here? And da, 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 da. We're not even talking about that. Now it's about, how do I help people? How do I serve 10,000 people instead of 100 people or 10 people? How do I serve 1 million people? How do I serve 1 billion people? How do I, execute God's will for my life here on earth? How do I do that? That's way more interesting to me than, Denzel, how do I do this chunk here and blah, 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 and da, 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 da. Right? That's all the beginning stuff, right? This is ground level, beginner, intermediate, moderate stuff. The 10x stuff, that's the big think. That's the thinking big, right? And, giving credit where credit's due. 10x comes from Grant Cardone. So if you don't know who that is, reach out to him. Or, well, you really can't reach out to him at this point. But you go on his YouTube channel, you read his books, you read the book called The 10X Rule, you go to a 10X Growth Conference, and then you'll get to see what I really mean, okay? That is my lesson. It was quick, okay? I'm done. I'm going to now turn it over to some Q&A. I want to get your questions, and I'm not going to spend too much time on here. I just wanted to share with you a nice case study, take you through the process, debt snowball, velocity banking, infinite banking, now 10x, okay? So at this very point in time, they are now just max funding policy. They're going to borrow from the policy. Instead of paying off debt, they're going to buy books. They're going to maybe buy a course, find a mentor, a coach, a life coach, attend some webinars, workshops. They're going to learn and they're going to identify the problems in the industry that they work in and see if they can become the solution to that problem, or do I need to pivot into something else that can make me a ton of money, that I can either use my skills over here and apply it here, or gain new skills and get paid for that at an exponential rate, All right. So now let's look at some questions. All right. Rick says, I think you tie concepts better now than your early videos. However, that may just be my own understanding. I would say so. I think I got better. Cool. Your authenticity is unquestionable, and your logo conveys that as well. Thank you. Smooth teacher, Kingdom Authority. Okay, we're commenting from before. Appreciate that. Legacy leader. Hello, I'm new, but this guy spits hot fire. Thank you. Julie says, sounds good. Do you mind sharing their ages? Yes, Debbie, they are in the wife, early 40s. Husband, mid-50s, late 50s. Wife, early 40s, mid-40s. So plenty of time to 10x. I can't tell you how many clients I work with that are in their 40s, in their 50s. They're like, Denzel, you know, I only got 10 years left. I'm like, what do you mean you only got 10 years left? You're only 50. What are you talking about? In 10 years, you'll be 60. What are you trying to tell me? You're going to be in a wheelchair at age 60? You're going to be fully paralyzed? And guess what? I have clients that are fully paralyzed, disabled, older than the 40 or the 50-year-old, and their mindset is, I am not dying tomorrow or anytime soon, so I need to expand, I need to scale, I need to reach more people. Can you believe that? Like, imagine talking to somebody, they're in their late 50s and 60s, and they have the mindset of 10x, but they're in a wheelchair, fully disabled, head to toe or chest down or just waist down, whatever. They have a disability, whatever it is. And in the midst of all of that, they're still asking the question, what's my purpose in life? Where am I going? Why am I here? Where am I headed? Who can I serve? How can I 10x my income? How can I create not only financial freedom for me, but how can I create financial freedom for my neighbor? How can I create financial freedom for the stranger on the street? How can I create financial freedom for my wife's sister, the brothers, aunt, uncle, niece, nephew, the cousin, the friend, the coworker? It's big think, okay? Hope that helps. Terry says, hello. William, you got this. Pay off bad debt is good. Maintaining good debt is okay. Yeah, like it. Jersey here, longtime follower. Enjoy the live presentations. Glad you do. James says, I'm here. Raymond, good information. Thank you. Awesome, thank you. Is the 8K income gross or net? That is net. So in all of my videos, I always show net numbers. Gross doesn't mean anything to me when I'm working with your numbers, especially when I'm doing velocity banking. I need to know the net, what you actually take home, what you actually net in cash flow, what you actually spend, with debt payments and living. And then what I do is I try to underestimate income, underestimate cash flow, overinflate expenses, so I have a nice little buffer, so that when we put a velocity banking strategy in place, it's always going to perform less than the actual. And I love doing that with my clients because most of them don't even pick up on it. But if I lowball the results just by a little bit, like say for example, you cash flow $1,500 a month, but I'm going to do a scenario. I'm going to run your numbers based off $1,300 a month, $1,350 or $1,400. I'm just going to lowball it a little. Let's say you spend $5,000 a month. I'm going to illustrate $5,200 a month, $5,300 a month. And, you know, the first chunk I illustrate, hey, it's going to take you 7 months to pay it off. But then you do it in 5. So you call me up. You're like, Denzel, you know, hey, I don't know, man. Velocity banking is working. I'm like, I know. It's going fast. Okay, next chunk. Here we go. It builds so much energy and my goodness, it goes really good. Ray says, I'm a new lifetime client. Really enjoy your genuine delivery. Thank you very much. Hope you're enjoying the manifesto course. I added a ton of new material in there. I hope you're going through it and getting what you want. Thomas says the best real estate investment is the 6 of space. Oh, the 6 inches of space between your ears. Got it. Felt a little dumb there. Sorry. What is the transaction of, I think, hey, S-Bits, please comment the rest of your question because I don't see it in the chat. Caroline says, not familiar with the whole life policy. How does that work to get funds out? Okay, so let's deal with that. Okay, so we'll create some space. Okay. So with, I'll use MassMutual for example. MassMutual, you can either take a loan out via check or direct deposit. They have an app, right? So MassMutual has an app you can download on your phone, and you could request a loan right from your cash value life insurance policy, direct deposit right to your checking account, or you can have a check delivered to your house, which takes more time. So I usually don't prefer that. I tell people, you know, direct deposit it. So that's the logistics of it. Now let's go over like what happens when I take out a loan, okay? So let's say she wants to take out $10,000, okay? The insurance company, right, is going to charge her an interest rate. Let's say 5%, right? That's what they're going to charge her on the 10K, and that 5% will be simple interest. With MassMutual specifically, because every company is different, with MassMutual specifically, it's simple interest daily, compounded. What does that mean? Let's do some numbers. We've got 123 people in the house. That is awesome. Thank you for being here. So 10,000 times 5% is $500. Okay? Divided by 365. She will be paying about $1.36 a day. So simple interest daily compounded, she's going to get charged $1.36 a day per day for as long as she owes the 10K. Works just like a personal line of credit, home equity line of credit, or all-in-one loan. Okay? It does not work like a credit card, where with a credit card, it's the same wording, simple interest compounded, right? But on one day it'll be $1.36, the next day it's $1.39, the next day it's $1.41, the next day it's $1.43. So it's like you're being charged simple interest compounded, where the original amount keeps compounding itself. That is not how this loan will work. Only credit cards do that to us. And that's why paying off credit card debt is so much harder to pay off. Oftentimes when you look at the statement, it says it'll take you 19.5 years to pay off $6,000. And it's like, if you just pay the minimum monthly payment. Why is that? Because you're getting charged simple interest compounded daily on not the original balance owed, but on that new balance every single. So it would be $10,001.36, and then it's $10,003.32, and then it's $10,006. So you get charged interest like that. So that is not how this gets calculated. We will get charged $500 for the whole year if I keep the loan outstanding for the whole entire year. Okay? At the same point in time that you took out a loan from your cash value life insurance policy, your $10,000 that's in cash value is now being collateralized, can I even say that? It's collateral against the loan. So the insurance company gives you their $10K and they hold your $10K in cash value uninterrupted, and it will continue to earn a dividend rate. So for Mass Mutual, I believe they're at 6.1%. I think they might go to 6% this year. I'm not sure. So you're going to be earning a gross, there's that word again, you're going to earn a gross rate of return of 6% on this money, right? Your net internal rate of return is going to be a lot less than 6%, probably like in the first couple years, you're negative interest. And then after like year 3 or 4, then you start yielding like 1, 2, 3, and then it goes up to like a steady 4 for a period of time. That's net. So you're gonna earn a gross rate, but you're gonna net a lower rate of return. So if you're wondering, Denzel, isn't that less? Not exactly. It depends on how you borrow your cash value, how much I should say. It really depends on how much you borrow. So let's do an example where if this person has a total of $30,000 in cash value and they only borrow 10, so they're going to be earning an interest rate on all of the cash value as if they never touched it in the first place. Meanwhile, they're getting charged an interest rate over here, simple interest, right? Now, the other thing that's important to know is when you fund a policy, let's say you're doing 30K a year is the max amount, where you could run into an issue in terms of taking out loans and say not paying them back. Where you can run into an issue is if you don't actually pay in $30,000 the second year, or the third, or the fourth, or the fifth. You know, like the following years, you only put in $5,000, $2,000, you know, $6,000, $10,000. You're not putting in what the policy was designed originally for. If that's the case, you want to at least pay your interest on your loans so it does not exceed or interfere with the growth of your cash value returns, right? So what happens is you've got two separate things going on. You've got your cash value earning a gross rate of return of say 6%, but you're netting negative in the first 1 to 2, maybe 3 years. And then in reality, you're only earning 1%. Then it goes up to 2, then 3, then 4. But you have to understand the amount of money that you're paying in each and every year is not equal to the amount that you borrow out. So a rule that I have in place is I usually do not borrow more than 66% of my total amount of available cash value. So I only leverage a portion of those dollars so that I can go execute those dollars somewhere else and earn a higher rate of return somewhere else outside of the policy, right? And then when I make more money, I'm paying an interest rate over here inside the policy. I'm also earning an interest rate. The interest that I earn will go like this, right? It'll continue to go higher and higher. And the loan interest will kind of like trail, but it won't match what it'll trail it, where you're not getting charged the same amount or more than what you're earning. Because eventually your money starts to compound. So what ends up happening is the amount of interest that you get charged on your loaned dollars has no effect to what you're earning. Has no effect. Unless the policy doesn't perform, the dividends go down, right? That can have an effect. Dividends go down throughout the years. Let's say you were illustrated something, but the policy is doing a totally different thing. This goes into policy design and being very educated around the product, making sure you're aware of these things, not borrowing too much money, not overextending yourself, over leveraging. That's where you can run into an issue. Now, the way you save yourself, if you're in this kind of position where you're like, oh man, I got too many loans outstanding, I got this interest is starting to compound itself, the policy's not, I haven't been max funding it. The best way to save yourself is just restart the interest, like pay down the interest so it stops compounding and kind of resets on whatever the principal amount that you borrowed. That's a good way to save yourself. And then try to earn more money on what you initially used the money for. Did you use it to pay off debt? Okay, you cash flowed, you increased your cash flow, now drive it back into the policy. Continue to max fund. This is why you'll hear me in my videos where I often say max fund over pay back loans. Because if I continue to max fund my policy and borrow out a limited amount of funds, the loan interest will, no matter how long I have it outstanding, it'll never exceed the cash value growth. It won't affect the cash value growth. When I go to restore the loans all back to zero, it would have no effect to my cash value. It would have kept growing. So I hope that helps. Pretty long-winded answer, but I like going in the meat and potatoes of it all. I'm going through manifesto videos and funding mass mutual policy for my kingdom. Self, wife, and 3 kids. Can't wait to 10x. Love it, love it, love it. Really interested in the details of doing both velocity and IBC together. Can't wait to hear more details. Cool, cool, cool. So, that was earlier. Yeah, meant to say 10x. Cool. I'm so grateful that I've come across your videos. I've learned so much from you. I wanted to say thank you. Thank you. Appreciate it. Tony, so cool to see someone grow with you from the start. Approximately how much debt was eliminated over the past 2 years prior to beginning infinite banking? For this specific client, I wish I took better notes. I wish I took better notes. They had I know they had 2 cars. That must have been like 20+ thousand. Student loans, that was 30, 40, probably plus thousand. They had credit card debt, that was probably over 10,000. And they've knocked out a big portion of their mortgage debt. So I want to say their total debt was well over probably 330,000 at the time when we first met. So now they're all the way down to 210. They've done a lot of progress for like really not a whole lot of income. They made a lot of progress. Ramon, my husband and I have applied for a revolving loan. Got denied. We do have $16,000 in cash. So I just had an idea to just treat my cash as a revolving loan, which I'll use to pay off credit card. Okay, what you could do is take that $16,000 and maybe go get a secured personal revolving line of credit. You said you got a revolving loan, so I think we might want to correct our wording there, because I know the banks make it confusing with the terminology sometimes. So you want to make sure you applied for the right kind of debt tool. Personal line of credit, home equity line of credit, credit line, credit card, all in one loan, right? Line needs to be revolving. But he says, let's see, but after that, I'll be stuck on what to do with this $16,000. Okay. Yeah, so if I was in your position, my credit score is not great, I would rather go and get a secured personal line of credit to build my credit back up, because now I got that inquiry. Maybe you did not watch my videos, you got excited, you watched 3 videos about velocity banking, you went and applied for a line of credit. They smacked you in the face, they said, no, you're denied, get out of here, or whatever it is, whatever it was. So now we have to go back to the drawing board, get ourselves educated, build a relationship with the bank, wait about 6 months or so before reapplying. In the meantime, maybe we could go and get a secured personal line of credit. You do velocity banking that way. Okay? So let's say with a secured HELOC, it's at, I don't know, 3%, and then that credit card is at 26.99%. Another credit card is at 17.99. You could consolidate using the bank's $16K while they collateralize. Can't even say the word. They hold your $16K. There's some banks that will put your $16K in a CD, in a money market account, where it'll earn a rate of return while you use their dollars to go do what it is you want to do with it. So you can look into that as well. That can be really helpful. Just cleared all debt. Only have a mortgage at $52,000. Would it be appropriate to start trying to do velocity banking with a credit card since I don't have a line of credit? Also, would it be best to apply for a new one with a 0% interest rate? There are some credit cards that function like a personal line of credit. If you have a credit card that functions like a personal line of credit, meaning you're able to pull cash out without any cash advance fees, without any transaction fees, so to speak, then I would use that credit card and we could potentially do velocity banking on the mortgage if your intent is to pay off the mortgage. If it is not to pay off the mortgage, then maybe we can focus on a 10X strategy, maybe infinite banking strategy, okay? And we can go that route. So let's stick with you just want to pay off debt. You just want to become debt-free. Then it might be better if the credit card does not function like a personal line of credit. It might be better to just use the credit card to run bills, especially if you get a 0% card, to run bills, get cashback rewards, points, build your credit up, maybe do debt snowball for a period of time on your mortgage, and then reapply or apply for a home equity line of credit or a personal line of credit later down the line. Hope that helps. Michael says, peace, peace be with you. Could a mortgage be considered a bad debt? For sure. If it doesn't pay me money, yeah. You know? So yes, it could be considered a bad debt. Maybe the debt needs to be restructured. Maybe it needs to be refinanced. Maybe it needs to be rented out. You know, like there's a lot of creative strategies that we can, use. How to something the bank when they want to offer their own closed loan product when you want HELOC credit score is good. I have no idea what you're saying. Unfortunately, the grammar threw me off, so you're going to have to retype that question. I saw one illustration at age 75 drops to 50,000 cash value from 95,000, and the death benefit drops as well. Is it fair? You know what? I'm not sure what you're talking about. Maybe drop the link for everybody to watch, and maybe I can take some time to watch that as well, so I can get a little more insight on what you're saying. I'm wondering if you're saying that you said 50,000 cash value from 95. I don't understand how cash value can drop. I've never seen that happen before in any policy, a good or bad policy. I've never seen cash value go down. I've only seen cash value go up, whether it was a good policy or a bad policy. I've only seen cash value go up. I've seen death benefit drop off. Yes, that can happen. So for example, you could have a policy where you start off with $1 million and you're max funding it for the first 7 years, first 10 years, first 14 years. And then that next year that you're done funding, the term rider that you had on there drops off. You no longer need term insurance on your whole life policy because you're no longer max funding. You've finished that period, let's just say. And now you're just PUAs and base premium. So the death benefit might drop to, I don't know, 900,000 or 750,000 for a period of time, and then it gradually starts to go back up again. Okay? So is it fair? It's a matter of how do you want your policy designed? Because there's many different ways to do it. So fair, not the right question. Is it effective? Is that effective to have my policy do that? Or would that be ineffective? If it's ineffective, is there another way? And we want to do it that way. We want to ask that question. Can you continue to fund the policy while you have a loan outstanding from the policy? Yes. I have 60,000 in loans in my policy. I have 131,000 in cash value. My anniversary date is coming up in June. So I'm going to dump 70,000 on my anniversary date, right? I'm going to dump 70,000 and I'm still going to have, the loan outstanding. So I can continue to fund the policy, max fund it without having to pay the loan or the interest. I can leave that just there. It's a loan that I never really have to pay back. In my personal financing situation, I'm not paying back those loans until the 6th or 7th year. 6th or 7th year, I'll have about over $250,000 in loans, and then I'm going to write a check to restore the loans all back to zero, max fund the policy, and then I'm going to take out another one big loan of like $400,000 and go buy multifamily real estate. That's the plan. Hey Denzel, just paid off my debt. I have 4 credit cards, 2 are low interest and the other 2 are higher. Should I close the 2 or higher interest cards? I would never close my credit cards as I won't use them again. Or is it better to leave them? Yes, I prefer to leave credit cards open. Let the credit card company close it on us before we voluntarily close our cards. You could easily, once a year, swipe the card, buy a bottle of water. Fill up your gas tank once, buy a bag of chips. Like one time a year, you could use that one card, okay? So that you show long credit history. Some of my oldest credit cards have the lowest credit limit. I don't use them. I got a HSBC card, $2,000 credit limit. I've got a BBVA card, $1,000 credit limit. Once a year, I might use it to swipe it one time, and that's it. Just to keep it active, because those 2 credit cards are like 4, 5, 6 years old versus my newer cards that are only 1 or 2 years old, but I'm swiping like 5, 6, 7, 8, 10 grand a month through these cards and then paying it off in full. So every now and then, if I get a credit card that I just haven't used and if it just falls off, let it fall off on its own. I would rather they close it before I close it. Okay? Okay. Okay, yeah, personal line of credit. Got it, got it, got it. When you request loan through MassMutual app, the money is direct deposit into your checking account within 1 week. That has been my experience. Cool, cool. Okay, you commented twice. All right, we answered that. Keep the credit card, you'll increase the credit score. Yep, yep, yep. Can you do an example with an all-in-one loan? Do you use the 66% rule with that policy funding with an all-in-one loan? No, no, I do not. That would be different. See, with a with an all-in-one loan, it's a little bit different because the intent, if you get an all-in-one loan, is to technically pay off the debt of that mortgage, right? So if you get a all-in-one loan, I don't know, for $500,000, right? Let's say you replaced your $500,000 mortgage with a $500,000 all-in-one loan, but you had like $200K in equity. So I don't know, maybe your credit limit is a little bit high. I don't think all-in-one loan works like that. So I don't want to put that. I don't want to be incorrect on that. I think it might be, but I don't want to be wrong. So we'll have to do some more research on that. I'm still learning about these things. But if I had one client do this where she replaced her mortgage with an all-in-one loan, right? So let's say it's $500K is the starting amount, and now she's gonna, do velocity banking. All income goes in, expenses, come out, cash flow stays, right? So we're doing velocity banking on the product itself, the all-in-one loan. We're doing velocity banking on the debt tool. The client that I was working with, she's looking to put a policy in place. I think she was looking to fund like $100K a year, right? So what she did was she dumped $100K into the all-in-one loan, had it sit there for a period of time while she learns about infinite banking, put a policy in place, design different illustrations. She can have her money parked in the all-in-one loan safely, reducing her interest costs in that. When she's ready to deploy the funds, she'll pull it back out, fund the policy, borrow out money, and then ideally invest. Okay? So when we're doing velocity banking and infinite banking together, we have to still always base our numbers of what we're going to fund. We base it off our 4 major numbers, okay? So let's get some clarity with that first. Let's make sure we're understanding that correctly, that it's still based off our numbers. So if I have a HELOC at 25K, that's my debt tool that I'm going to leverage. 66%, right, is 16.5. My cash flow is $2,000 a month. 2 times 12, $24,000 a year is my yearly cash flow. Anywhere between $24,000 and $16.5 is what I should fund into a policy if I'm at that point. If I'm trying to figure out, okay, how much should I fund a policy? So I can either be conservative, fund a policy below my cash flow like this client did, $16,500, right? They're gonna cash flow $24K in a year. When we initially funded the policy, they were not cash flowing $2,000. It was probably like $1,500. So I think they were at like $18K. So between $18K and $16.5 was the number we were kind of at. And that's why they created that extra space, because they figured they'd be cash flowing more later down the line. So, you know, you can design a policy like that. But when we're deciding on how much to fund a policy, what you don't want to make the mistake of is saying, oh, my cash flow is this a year and I can leverage 16.5. Okay? I've done some videos in the past where I went over this. In very rare cases does that make sense. In most cases it does not, because the likelihood of that person being disciplined enough to leverage like that, typically they got a couple more zeros behind their income. You know what I mean? Like, they're making higher money, so they understand how to leverage. But when I'm dealing with people that are making, like, you know, 8 grand, 6, 5, 4, 3, you know, K a month, let's not get too excited on this leveraging. Let's make sure we want to leverage. We want to multiply our dollars, use $1 more than once, but not over leverage. Put us in a bind. You know, infinite banking is great, but let's not put that on a high pedestal, because remember, I would rather you 10x first, get the capital, then drive it into the policy, than to take all your cash flow in a year plus leveraging a debt tool to try to throw in, you know, a $30,000, $40,000 policy when you only make 80 grand a year. That's 50% of your income. That may not be as effective. Can it work? Yes, it certainly can. It's certainly, I'm not saying it won't. I'm just saying the likelihood of people doing that, going that far, you better know your numbers. And you better not rely on some kid that's 25 years old, right? Like, just being totally transparent. You better know your numbers. You better understand the concept very well and know what you're getting into, and not get sold into a product such as cash value life insurance. You better know what you're doing. Don't get sold. Be very aware, okay? Let's see, which credit card functions like a line of credit? Oh, okay, so let's go over that real quick. It's a good question. So, I'll give you an example. FCU stands for Federal Cornerstone Credit Union. Or maybe it's FCCU. I think it's FCU. Cornerstone Credit Union, something like that. They're up north. They give you, let's say, a credit card, $15K. Maybe their interest rate is 9%. Okay? So, with their credit card, you can withdraw kind of like a convenience check. You can withdraw money out of credit into cash, and that would go into your checking account. Once it's in your checking account, you can use that money to pay any bill or chunk at any debt. So you cannot take a credit card and say pay your mortgage directly, or else you're going to get charged a fee, right? But with certain credit cards in the marketplace, you can withdraw, convenience check, almost like a balance transfer, to your checking account, and then your checking account makes the chunk, pays the bill, right? And then, because it's a credit card, any bills that can be paid with a credit card, you just swipe the card. Get your points, get your cash back. Now, because I have the ability to withdraw into cash, well, I could now take all my income and pay the credit card in full, because I know I can pull that money out that has to be paid with an account and routing number, such as a car payment, electric bill, sewage, mortgage payment, insurance, life insurance, things like that. So that's how that works. That makes perfect sense. That would help my credit get to the 720 that I need for HELOC. Thank you. Hope that helps. Great. Is it worth to take 20,000 from HELOC to put them in the whole life insurance, then at once take 15,000 from the insurance as loan to pay tuition fees? No, probably not. I don't like that. So that means I'm going into debt 20,000 from the HELOC to fund a policy, to then borrow 15,000. That's more than 66%. That's affecting with my rule of borrowing. So if I do a $20,000 a year policy, right? That's not a big policy. 20,000 a year. Let's say it's a 90-10 split. So 2,000, right? I'm only going to have 18K left. Then you have term costs. Say that's I don't know, $400, $600 or so. Then you have sales load charge. Then you've got PUA fee. So maybe you net, maybe your starting cash value is say it's 16.5. Starting cash value. Well, from that, you can only borrow roughly up to, it might be like 88, 89% in the first year, but you can only borrow up to 90% in the first year. So 16.5 times 90% is $14,850. So if you were to borrow out technically all of your cash flow, say it's 15K that you have the ability to borrow out in the first year, and you borrow all 90%, to then go pay a tuition fee. Now, what do I get out of paying that tuition fee up front in advance? What do I get from doing that? What is my ROR, my rate of return? What is my, am I earning anything back on that? Because if I'm not, which I know you're not, there is no savings by paying tuition up front, right? What am I saving on? I'm just paying a bill, right? So not only did I borrow 20,000 at an interest rate, that's a cost. Then I threw it into a whole life, 20 grand, lost 2K right off to the start, lost another 400 to 600 term costs, another couple hundred bucks PUA. I've got starting 16.5, lost another 10%. I only got 15K to use. And I leveraged the whole thing. Remember, I have a loan interest on that. So I'm paying loan interest on the HELOC, loan interest on the loan. I save nothing by paying the tuition. It would be a different story if that 15,000 could guarantee me a 20% rate of return or something like that, or a 10% rate of return, so it can make up for this cost and the HELOC costs and all that. Then maybe. But I don't like the idea of it just by running the numbers. And that's all you got to do, my friend. Run those pretty little numbers until you get where you got to get to. Does that make sense, ladies and gentlemen? Hope it does. We are an hour in. Are you enjoying this? Are you getting value? Let me know. Comment yes, no, maybe so. Let me know. How you doing? How to argue against the bank when they want to offer you their own closed loan product when you want a HELOC credit score is good. Thank you. Much better on the grammar. Appreciate that. So, we don't want to argue. We want to build a rapport. We want to build a relationship. I want to know the first and last name of my loan officer, where they're from, what they do, what their goals are. I want them to know me by name when I call in. I want to know their work schedule, so when I call in, she's there. She'll pick up. Susie will pick up, not Joe. I don't know Joe, but I know Susie. All right, I want to talk to Susie, right? You know, I want her extension line. Build a rapport. You guys are not taking enough time to talk to the bank. You guys got ants in your pants. You're so excited to go apply for a HELOC. You don't know the first 5 words to say. You haven't watched the videos, you haven't gone through the course, and here you are shooting yourself in the foot trying to argue. Wait a minute. We don't want to argue, ladies and gentlemen. We want to negotiate. We want to negotiate, make the bank our friend. At the end of the day, there is a human inside that big old operating system called the banks, right? There's humans involved in the transactions. You want to know every single step process of all the way so that you're fully educated, so that you can appreciate and say, hey, thank you for getting me that personal line of credit. You changed my life. Thank you for getting me that home equity line of credit. I'd like to bring you more business. I have another friend that's looking to get a home equity line of credit. Can you help them just like you helped me? Because 3-4 years from now, when you're debt free, you go back to that same loan officer and say, hey, I want to go buy some multifamily real estate or some commercial real estate. Who do you know that you can connect me with? What table can I sit at just by knowing you? So we don't want to argue. We don't want to jump the gun. We want to get educated. Watch the videos. Watch the videos. Watch the videos. That's all I say. Watch the videos and you'll learn it. It's not just free, right? Because, you know, free sometimes is worthless, because if you don't take action on it, then it's not worth it, right? So you really got to act like you're paying for you to watch this video. You're paying because you're using your time to get educated. Time is money. So look at it that way. What is the difference between direct and non-direct when starting a policy? Great question. So, Mass Mutual is a non-direct. I believe they can turn into a direct later on, if I'm not mistaken. So non-direct simply means I take out that $10,000 loan at 5%, and let's say I got $30,000 in cash value, earning 6%. Mass Mutual is not going to recognize, they're not going to non-direct recognition, they're not going to recognize that I have this $10,000 loan. They're going to keep crediting me the same rate of return on my total $30K as if I never borrowed the 10 to begin with. Okay? A direct recognition. I take out 10 grand. The loan interest rate is 5%. Let's say I got 30K in cash. Let's say, you know what? Let's say the loan interest rate is 6% with this direct recognition company, different insurance company. Let's say on 30K cash value, the dividend rate is 5.8%. Okay? With a direct recognition, the insurance company is recognizing that Denzel just took out a $10,000 loan. We're going to charge him 6%. But on that same $10,000, we're going to credit him 6%. So we're going to match what we're charging him versus what we're crediting him. We're going to match the same rate. And then the other $20,000 is going to earn 5.8%. That's how direct recognition usually works. Some companies, the rates might be different, but that is the gist of it. Okay? Hopefully that helps. You guys getting value from this? Cool, good stuff. We're an hour and almost 30 minutes in. The designers should design the policy, not the clients. I wouldn't necessarily agree with that. So yes, the case designers at the insurance agency is designing the policy. Yes, for sure. But you as the client kind of like buying a car, you're saying, hey, I want floor mats. I want 3 cup holders. I want 6 USB plugins. I want, you know, TVs in the back. I want, you know, leather seats, red interior, black outline, chrome finish, LED lights, all the bells and whistles. You as the client need to know what to ask for so that the designer can create what you want. That's why it's very important that you guys that want policies in place for yourself, you want to get very educated, not sold a strategy of infinite banking. Because that's what an insurance agent is there to do. They're there to sell you on the policy. But you as an educated customer watching these videos, you're coming equipped. You're like, hey, Mrs. Agent, I want this, 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 and this. Can you design it, yes or no? He says yes, cool. Comes back, they provide a design. You, watching all the videos you watch, you know how an illustration is supposed to look like. And you look and you say, hey, Mr. Agent, that's not what I want. I want this, this, and this. Can you design it, yes or no? Final warning. Yes? Okay. So they go back. They give you another policy. You look at it again. You're like, you know what, Mr. Agent, I don't think we're in alignment. I don't like this design. Thank you for your time. I appreciate it. I'm going to look elsewhere. Have a nice day. That's it. No need to argue, right? No need to fight, fuss, try to prove one another wrong. If they don't do what you want, why are you still there? Right? It's like being in a relationship and, you know, they operate one way that's totally out of alignment to your morals, ethics, values, behaviors. Why are you still with them, right? So that goes with anything in life. Anything. Plus Ultra says fire again. Cool, cool, cool. Okay, what if you have a credit card that charges monthly fees when you have a 0 balance? What? That's a terrible credit card. I would close that. Okay, that's the one exception I'd make. If you have a credit card, ladies and gentlemen, that's charging you a monthly fee, that is a scam, in my opinion. Okay, I don't like that. What? That doesn't make any sense to me. To have a 0, so that means I always have to have debt on it, essentially? A running balance? No way. That don't make no sense to me. Quick question from Patty. I have a 0% car loan that is coming in at a 30 in the cash flow index. Uh-oh. They know about cash flow index. Payment is $655. Does it make sense to velocitize it? Only other debt is the mortgage. I believe, based on cash flow index from Mr. Garrett Gunderson, who teaches it, I think him and I would agree. If I have a debt at 0%, and he has so many videos, so many conferences where he always asks this question, if I give you $1 million at 0%, how fast are you going to pay me back? How fast would you pay me back? Please comment. Everybody, I'm asking you a question. Please comment. If I give you $1 million at 0%, how quickly are you going to pay me back? My answer is never. If you're charging me 0%, I'm going to pay the monthly minimum payment forever. What is the incentive for me to pay off that debt? There's no incentive other than I no longer have a payment. But if I can afford the payment and you give me $1 million and I go take that $1 million and go earn a 10% rate of return, 20%, or I multiply them, I turn $1 million into $2 million, I would never pay that back. So I'm pretty sure the GOAT, Garrett Gunderson, the money Jesus guy, would agree with me that you don't pay off 0% debt. Let it roll. Go make more money. Make more money. Always. Always make more money. All right, next question. If you have $50,000 in cash and wanting to open up a high cash value life insurance, is it better to fund for account on kids or use the money to fund my policy alone? Which option do you think will be better off? I guess based on where that 50,000 is coming from. So is the 50,000 capital? Is it a lump sum? Is it a what's the term? Oh my God. Is it a windfall of cash? Or are you cash flowing 50,000 a year conservatively? If you're cash flowing 50,000 a year conservatively, I think we could easily fund a policy on yourself. And then based on the cash value, based on the age of your kid or kids, I'm assuming they're young. If they're under the age of 18, you really can't put too much insurance anyways. And by the way, in order to put a policy on a child under the age of 18, you, mom or dad, has to have life insurance anyways. And then they take 50% of the death benefit, and that's what you can insure on your child. So what you could do, which I have a lot of my clients do, is they take the 50K, they fund the policy on themselves, and then they borrow, and then they put a policy on kid number 1, kid number 2, kid number 3. So the same 50K funded your policy, funded all other 3 policies. It's the same cash value, right? So that means the next year when you dump 50K in, you borrow money out, you fund kid 1, kid 2, kid 3. So now the whole kingdom is protected. Okay, that's a cool way of looking at it. Hopefully that helps. God bless you. All right, next question. Thanks, Denzel. Thumbs up, people. Yes, do me a favor and hit the like-o button. Appreciate that. They work like, oh, okay, I was right. Okay. So like your loan that you replace into an all-in-one loan is say 500K, but you had 700,000 in equity. Maybe they'll allow you that extra equity. It depends, I guess, on how you structure it. So that's good. Yeah, he says 75 to 90% LTV. That's good. Who will invite me in Clubhouse? If you don't know anyone, I thought you, Denzel, would invite me in the Clubhouse. I cannot join the club. Yes, I'm running out of invites every single time. So if you're already on Clubhouse, okay, you can invite people, but you only get like 3, 4, 5 invites. So be very strategic with who you give your invites to. If you are a client of mine in the lifetime or maybe in the manifesto and you're not on Clubhouse, reach out to me and let's see if I can help you. At the moment, I don't have any more invites. I have to wait for more to come in. I think I just got 2 more, so I do have to wait for more to come in. Now, in order to get on Clubhouse, you have to have an iPhone and you have to get invited, okay? The best way to get invited is to make a post on social media. Let your friends and family know. Maybe somebody in your network is on Clubhouse and they can give you an invite, okay? So you must have an iPhone and you must get invited, okay? I have very few invites, and I usually like to use those on my clients that are gonna go on the app and actually use it. So, I save that for them. So if you're a client of mine, one-on-one, you have the ability to call me and book phone calls with me. Be like, hey, Denzel, I wanna get on Clubhouse. Give me a link. Be like, you got an iPhone? Okay, cool, let's go. Let's have some fun. Okay. I have an all-in-one loan, very easy to use, love it, yep. I hear nothing but good things. I have an all-in-one loan. We have a one-on-one schedule in 2 weeks. Looking forward to that conversation and planning. Yep, sounds good. That's what I use to fund my 2 policies. My and my wife have. You didn't finish your comment. once your HELOC reaches a zero balance, do you still keep paying your expenses with the personal line of credit? No. So at that point, you're weaning yourself off of the line of credit. So you're going to notice when you make your chunk from your debt tool, income goes in, expenses out, cash flow stays. Income goes in, expenses out, cash flow stays. Right around month 5, month 6, maybe sooner, you'll hit zero, but it may not be a true zero balance, meaning you still have to pull money from your line of credit to pay bills because there's no money in your checking account. But if you hit zero on your personal line of credit and you still have $2,000, $3,000, $1,000 in your checking account, you want to use those dollars to pay bills, right? And then as that money runs out, then you pull from the line of credit to pay the rest of your bills. And then you'll get to a point where you're at a true zero balance where you no longer need the line of credit to pay your bills. So that is an indication that I need to make my next chunk, because you don't want to stay there. You're wasting time if you're waiting to get to a true zero balance. Usually, depending on the credit limit, if it's like 20,000 and up, we usually won't wait to hit zero. As soon as we get 1,000 balance, 2,000, 3,000, we're ready to, make that next chunk towards the next debt. Because usually the following chunk is less because your debts are less. They're starting to come down. You're starting to wipe it out. So you build that momentum. It's pretty cool. Hour and 36. All right, let's keep it going. I'm almost done with all the comments. Love the evolution of the couple's journey. Ran the full something of financial independence tool. Yep, they sure did. They sure did. I love Velocity Banking. Started mortgage in January. Cut 30 payments in February. We'll cut 42 in April. We'll cut 10 years off by September in 9 months, under 200K, then pay off in 36 to 42 months. That is awesome work. Awesome work. What kind of tool you're using? I guess you're talking to somebody else. Yes, sir. Cool. Citibank and Chase have both offered me loans from my credit card, which gets deposited to checking. So I don't think that's not exactly how the credit card I was mentioning earlier works. I don't have to take out a loan. It's just a simple withdrawal. It's like a cash advance, but without the fees. It's a convenience check. I get charged the same interest rate, or it might be a different rate, but not like extravagant. It doesn't jump like cash advance rates do. They jump on you and then they charge you daily compounded interest. You'd never want to do that, okay? That's what I was telling you about those cash advance credit cards. You get eaten alive. Who is the best mutual whole life insurance company? That's very hard to tell. I would say that's going to be an opinion. And anyone that gives a name, so I could say Mass Mutual, Guardian, New York Life, Northwestern. Those are the 4 major mutual life insurance companies. Mass Mutual, Guardian, New York Life, and Northwestern. In terms of profit, in terms of revenue, in terms of financial stability and size, they're the biggest. And then you have a bunch of smaller ones. You've got Penn Mutual, Security Mutual, Mutual of Omaha, you got Lafayette. These are the common ones that get used by a lot of insurance agents. You got Pacific Life, a lot of IUL agents use that. Allianz, there's so many. I think I would say each insurance company has their, maybe like their target market or how they do certain things. So before you just get a policy based on what some 25-year-old kid said, why not do the research, see how these policies stack up, how do they work, how do they operate, does that align with my personal financial situation and mission to become financially free? Does it solve for that? Citi calls these flex loans, charges a lower rate than the usual credit card rate for them. But is it an amortized rate or is it a simple interest rate? We want to find that out. Hit the like button so more people can see that. Appreciate it. I think we're at, what, 69, 70 plus likes? Cool. Appreciate it. Appreciate it. Thank you. Thank you. Yep. Like. True. Watch the videos. Way more information to manifesto videos than other streams. Yep. Yep. So that was my question earlier. Yeah. Not quick at all. Take my time. Yep. Slowly. Yep. So hopefully that answers the other question from before. Yes, that's what I thought too. It was a starter card for me, but yes, I just paid it off. So yes, I sure will close. Cool. Yeah, that was referring to the credit card that charges you monthly fees. Hail to the no. Yep, everybody's saying never. Yep, James said, dude, James, I'll never pay you back. Patty's like, okay. We get it. Denzel, can you explain the option of bank finding a policy? Option of, you're going to have to rewrite that question. I think there's some grammar errors I'm not understanding. Can you get an Android phone on the side for us Android users to join you in Clubhouse? By the way, I don't own Clubhouse, so that kind of sounded like I can do something for you. I cannot. Android users have to wait. Clubhouse is specifically on iPhone only. They're in beta mode. The platform is a social media platform like TikTok, like Instagram, like Facebook. It's a brand new social media platform that is growing very fast in a short period of time. So when they open it up to Android users, then you'll be able to get in. It'll be a different story. What does Clubhouse do for you? Vanessa, Clubhouse is just like YouTube, but without video. It's like Instagram without video, without likes, without comments, without photos. Clubhouse strips all the social media out of it, and it focuses on social connection via audio chat. So the only thing you will see is somebody's profile picture and they're talking. That's it. And you hop into these clubs, these different rooms, and you have a conversation with somebody. And it's like going to a networking event. It's like going to a bar. It's like going to a restaurant, and you go to a table and you start talking to people. You're at a business workshop, business event. There's a general topic that they're talking about, and then people chime in, ask questions, dialogue, debate, talk about money, business, all things get discussed on there. And it's very fun. I'm going to be having a Clubhouse event tomorrow evening, so you'll definitely want to hop on there. I'll be doing a Clubhouse at 8:15 p.m. Eastern Time tomorrow, so you'll want to be there. If you get on my email newsletter by clicking the first link in the description, join my private Velocity Banking community. I will update you on all the events, speaking engagements that I'll be hosting, live streams, things like that. How can I get a lender to grant me up to 95%, 100% LTV for a fixed variable HELOC? So I'm assuming that is a first position HELOC that you're looking for. I have a ton of videos on the questions to ask your bank, okay? I have a whole entire step-by-step process in my manifesto course, but it's also I also have videos on my YouTube channel where I dive into this. So just go back into my videos. I also recommend looking up Mike Adams, Matthew Pillmore. They have great YouTube channels where they dive into, how to get approved for these banks. You don't necessarily have to pay for that information, but if you're looking to expedite, you kind of just go right into it. I do have a course where I kind of walk you through, give you all the steps so that you can position yourself properly, not shoot yourself in the foot, okay? I've had Discover offer 0% transfer fee and a 4.99% for 15 months. That's what I used to pay off our debt last year. They also offer 0% with 3% transaction fee for 12 months. Running the numbers to see what's best. Cool. Does the infinite banking concept work for older adults 60 plus? Sounds like it's only for younger people. I do have, my oldest client is in their late 60s. I do believe I have a 70-year-old that started a policy. So like 69, 70, they started a policy, male. And then I do have a female that did one as well. So it's not just a young man's game, although it's obviously beneficial if you start when you're younger, of course. The older you get, the more expensive it is, of course. It's only going to make sense if you have the numbers to support that kind of funding of a policy like this. What I would say to you, Craig, and others that are asking that question, I would type in IBC Global Inc. on YouTube and go to that channel. Steve Parisi is the face, the owner. He makes a lot of videos diving deep into the infinite banking concept. He gives a lot of values. He provides real life case studies and examples. So he does real life case studies and examples of, I think he did a 75-year-old case study, a 70, a 65, a 60, 55, 50, 40, like all the ages. He's done quite a bit. So I recommend that. Loaded the Clubhouse app in my iPad. It seems that it will work. I need only the invitation. I don't think it'll work. I think you need a, whatchamacallit, I think you need, can you send me an email. So I mentioned earlier, so if you're a client of mine, you're a lifetime client, send me an email that you're in the kingdom, and if I have enough invites, I can send one your way. Sometimes Clubhouse gives me more invites based on my activity on the app. So the more time I spend on the app, the more invites they give me. And then when I use those invites, they somewhat replenish me. So we'll see how that works. Probably amortize as they have a payback period when you pay them off in 1 to 5 years. Okay, I don't know what you were talking about. A VA loan will allow 100% LTV. Yep, those are cool. Steve Game Facebook messaged me your phone number. I will send you an invite. Cool, that's a client. So we got a client helping another client. Appreciate that. All right, we are at all of the questions. So I'm going to stop answering questions, and I want to just share with you some of the things that I got going on. I've got the Velocity Banking Manifesto course. It is now open, available to enroll. The link is in the description. You can check that out. You can go to my website. You can check out all my affiliates, all my partners, people that I work with. You'll see some playlists in the description below. If you're brand new, it'll say Velocity Banking Pregame Work. This is where you start. Then you can get to know, like, and trust me. You can see a whole playlist where it shows my channel progression, how I've built my business and my beliefs around certain things about money. Inside the Manifesto course, I've recently introduced Velocity Banking and networking in the kingdom. That's what I'm calling it. Basically, it's networking online. So to have a more intimate conversation, I'm going to be inviting all of my members, whatever level you're at. I have monthly payment options, an annual option, and then a lifetime option. So everyone that's already in the Manifesto course, in the last 48 hours of recently launching the course, we had over 35 people at this point, I believe, 35 people sign up. So that is awesome. I want to welcome you into the kingdom, right? We're going to have some fun. And what I'm doing this year, once, maybe twice a month, I'm going to do a Zoom meeting, and we're just going to network. So you're going to get to meet my veteran clients that have became debt-free, paid off 200,000 of debt, 300, 150K, 150K, or they know velocity banking really well. And what I'm going to do is I'm going to pair up my clients with each other to motivate each other, offer insight, give help and support, right? And really create a strong community, a strong kingdom community that values giving, helping, serving, and leading each other to do better things. So that's something I'm going to be introducing this year. So right now, at the moment, if you're looking to enroll in the manifesto, it is one of the most affordable courses in the marketplace to date for the velocity banking concept. I do cover infinite banking and kingdom authority. I talk about 10xing your income. I have over 22 sections currently in the course. About 100 hours of recorded material, probably more than that at this point. Okay. The monthly option, get paid $19.99 monthly. You can cancel at any time. So if you own it for a month and you're like, Denzel, this sucks, I don't want to do it, you can cancel at any time at your leisure. You can log right into your account, go to settings, and hit cancel subscription. You don't have to email me. You don't have to do anything. You just cancel it if you're not receiving the value. Okay. The other option is $147 annually, so you'd be saving money. The other option is you could have lifetime access to the course, to the program, right? And that's lifetime access to networking events that I'll hold inside. So anything that I add inside the course, you'll never have to, pay additional money for it. Plus, this comes with a 1-hour strategy session with me, one-on-one, okay? Which can be used at any time, doesn't expire. I recommend that people go through the course before booking that call so that we can go into strategy. I don't want to coach you. I don't want to teach you how to get a line of credit or explain that if I already did it in the videos. I don't want to waste an hour on that. So when I get on a call with you, I want you to have your numbers in line. So I can just be like, yeah, let's do that, let's do that, let's do that. Okay, cool, bam, bam, bam. That's great. Okay. So in addition to that 1-hour strategy, and this applies to all 3 tiers, I have something called performance-based coaching. So I don't know about you, but I've bought a lot of courses being an entrepreneur now. And what can happen is we buy shiny objects when we're trying to learn. We buy this $10,000 course, this $5,000 course, that $1,000 course, that $50 course, and then it sits on a shelf and it just sits there all pretty. So we end up not actually using it, unfortunately. So what I've done to improve the course itself, now that I've been running it for 2+ years now, is if you go through the sections, you watch the videos, you hit mark complete, you comment, you like, you attend live streams, that's going to earn you, credit, so to speak, in my kingdom. And I'm able to track your progress. I'm able to see how much videos you watch, how many times you log into the course. I can see the day you started and the last time you logged in to see how active you are. I can see your weekly progression, your monthly, your lifetime. I can see all of that. I'm like the eye in the sky. I can see all of your progress when you're on my course. So if I see that, oh, wow, Jessica completed over 40% of the course, right? So I have a whole entire system called performance-based coaching where you complete a certain amount of sections, and I'm going to reward you with a one-on-one call with me so we can strategize. Where are you at? Where do you want to go? Where do you want to be? What's your financial goals for this year, for the next 5 years, next 10 years, right? And then after that call, I'm going to be like, okay, if you do X, Y, and Z, and you watch these sections and do this, we'll reward you with more time. You don't have to pay for it. So you're earning credit in the kingdom. This is how I operate, right? So that at some point I can at least have the opportunity to talk to every single person that enrolls in my kingdom one-on-one at some point. In between that, while you're building your credit, you can attend these networking events. I'm going to be doing private live streams. Okay, so you see how I do this public live stream on YouTube now, but I do way more privately. Now that the course is open, I'm going to be doing more private live streams, less public ones, and we're just going to have a lot of fun. So the link to enroll is below in the description. You can see that there. Let me see. Let me just see some more comments here. I'm excited. I'm one of those 35 that just signed up. Awesome. Awesome, awesome. So everybody is being nice, giving each other invites. I appreciate that. I've watched so many videos this week. Yep, cool, cool, cool. How come my question and comment was not seen in the chat? It was not answered or addressed. Can you please type it again? Because I don't recall. Yeah, and I'm scrolling back up. Make sure you don't put any profanity or anything like that because it'll automatically flag it. But let me scroll up. Yeah, I never seen your comment. Maybe you wrote it, but you didn't hit send. That happens all the time. Maybe you thought you commented and yeah. I'm looking back. I just scrolled all the way back up to the top. I don't see your question. So go ahead and retype it. Be more than happy to answer that. Me and my husband, Facebook looks up on something, what? I don't even know what you're saying. Something where found many people with your name. Give me something specific. Okay. Okay. These guys are talking. Patricia, you got 20 seconds. Type your comment. Let me know. I did not see your comment at all. I just scrolled all the way through. It could very well have been flagged. I'll give you a couple of seconds. Got 117 people in the house. No, 134. I'm tripping. Oh, we got Oregon Cashflow Pro. Let me bring his comment up. Mr. James Barber. He's got some invites that he would like to share. He says, I got some Clubhouse invites, 5 right now. Feel free to hit me up if you want me to help you get someone in. So you guys can click on his YouTube channel and maybe send him an email. It wasn't flagged. I'm retyping. And it wasn't. And it won't send. Patricia, your comment might be too long. It has to be under a certain amount of characters. So, could be the issue. Rick says Mass Mutual versus Guardian. So, I'm going to assume you're asking, which one's better. I really don't look at it that way. I look at, me personally, I own both. So I own both, and when I'm talking to clients, typically those are the companies that I use most of the time. So, I have one with Mass Mutual, and I got one with Guardian. I like them both. I would say Guardian is great for people who have, you know, your hourly plus commission, right? So your income fluctuates. So if you have fluctuating income, you get big bonuses randomly throughout the year. You have a side gig, side hustle, so your income's always like going up and down. Guardian's probably going to be a little bit better because you can set a funding amount, say $50K a year, right? Or shoot, you can go as high as you want, $500K a year. I was just talking to a guy that just funded a policy, $500,000 a year. I got a client that just funded a policy, $250,000 a year. So you can go as high as you want based on your age, health, and finances. But however much you say want to fund a policy, you could set that number, and with Guardian, let's say you do it the first year, but you're not able to do it the second. The only thing you're really you only have to pay for the premium, the base premium. Say it's like $5K plus the term cost to keep the term rider in force, so that you can add PUAs. You're able to dump in the other 45 grand at leisure through the mobile app at any given time without any issue. With Mass Mutual, it's a little bit more of a process. You have to inform the insurance company what you're trying to do, and you can typically only add in funds around the anniversary date, 30 days before, 30 days after. Those are the major differences. Mass Mutual has a higher dividend rate than Guardian. Mass Mutual is bigger than Guardian. Guardian is a little more flexible. Guardian has has kind of like an IUL feature where your money could grow in the index, so you can earn up to 12.5% gross as opposed to just the dividend. So Guardian has a design where you could have a whole life and an IUL together as one. So Guardian does have that feature attached to their whole life products. That could be a benefit. Maybe that interests you. The potential, not the guarantee, but the potential to earn higher, a higher internal rate of return than just the standard dividends of the company. Okay. Okay, so now this is the last question I'm gonna answer, which was Patricia's. Thank you for typing it all out. Okay, here's the question again. As a 70-year-old, debt-free on credit cards, 830 credit score, need to pay off $95,000 mortgage and a $75,000 HELOC. So far, I'm putting $500 extra a month. Should I look for a HELOC or a PLOC? She said it was too long. Should I look for a whole life HELOC or PLOC? Okay. And then maybe the other thing I throw in there is 10X. Okay? Maybe that's another thing I'd throw in there. So, now, guys, if I'm not wrong here, did she not say that she owes money on a HELOC already? Right? $95,000 mortgage. Okay. Let me see something here. So, she's paying $500 a month extra. She didn't give us the four major numbers, so we're just gonna assume she's got $500 cash flow each and every month. 95K mortgage. She didn't give us the interest rate or the payment. So that's fine. 75K HELOC. I'm assuming $75,000 is what she owes. So maybe she has a first lien mortgage and a second lien HELOC. I'm going to assume that. What we don't know is if the home equity line of credit is a home equity line of credit or a home equity loan. So we don't know that. If it's a home equity line of credit, why do I need to go get another HELOC? Why can't I just do velocity banking with that? That's one option. Based on your income, if all you have is $500 a month and you're 70, okay, here's where things get radical and interesting. Ladies and gentlemen, if I'm 70 years old, I have to understand something that 30, 40 years ago, money operated differently than today. Okay? I need to understand that the traditional way of doing things with money does not operate as effectively in today's marketplace. Okay? So if I only have $500, the amount of time it's going to take to pay off these debts, I don't know, maybe 7 years or less doing velocity banking. Maybe that's your goal. So you'll be 77, you'll be debt free, but you'll be broke. You'll have maybe, I don't know, $1,000 more in cash flow, maybe $2,000 more in cash flow, but no money-making machine to keep the engines going as you start to decay in this world and eventually pass away and go visit the king. Okay? So this is where I think mentioning 10x needs to be addressed. I think it needs to be addressed. If I'm 70 years old, what can I really do with $500? What can I really do with $500 when it comes to paying off debt? I need to take the time to really ask the question, the four major questions. Who am I? Why am I here? What's my purpose in life? Where am I going? How can I 10x? How can I go from 500 cash flow a month to 5,000 cash flow a month? Is that a possibility within 7 years or less? Is that possible? With the current energy that I have, the current state of mind, am I healthy? Am I mobile? You know, and look, there's no exceptions. You know, I've got clients that are around this age that are operating and running businesses. I have people who are disabled. I know people who are blind on Clubhouse. Okay? I've heard people talk on Clubhouse that are totally blind or totally deaf, running and operating six-figure businesses that are in their late 40s, 50s, 60s, 70s, okay? There's no exception to the game of money. There's no exception to the game of money. You are racing against yourself. That's all you're doing. You're racing against yourself. So let's develop a strategy where we can discover your purpose in life, deliver value in the marketplace, okay? Me personally, look, if my mom was 70 years old and she still had debt, I would not be trying to teach her velocity banking, infinite banking, debt snowball. These are baby strategies. As a velocity banking consultant, some people call me an expert, guru, coach. As a leader in the space of velocity banking and infinite banking, I'm telling you, at 70 years old, these concepts are baby strategies. It's not gonna really do it for me. It might cut my debt-free timeline from 12.5 years to 7 or 6. That's wonderful. I'm not negating that. That's wonderful. But it still doesn't answer how do I create the lifestyle that I want for my life. So I don't know what situation you're in. I don't know if you're doing well financially, Patricia, or if you're not doing well financially because you only have, say, $500 extra in cash flow. Maybe you're putting money here, putting money there, putting money there. I think you need to be putting money in Patricia. I think before you leave planet Earth, I think a mass amount of people needs to know who Patricia and how to say your last name. I think people need to know what value you bring to the marketplace, okay? Do we need to be radical and say, okay, can we refinance this mortgage into one payment and have a lower payment, lower interest rate because interest rates are super low, and I can get the cash flow out and go, create a strategy, create value in the marketplace? Maybe that's a strategy. Can I sell the home? Am I willing to sell the property and go downsize, live somewhere where I can rent cheap and just focus on myself, read books, become a mentor to somebody, help build someone else's kingdom so that the Lord can trust you to build your own? Uh-oh. Did you catch that? Can you take the time to mentor someone else, help them build their kingdom so that the Lord can trust you to build your own? Uh-oh. Uh-oh. So let's figure that out. Let's really spend some time. Right? We got some people commenting, age 70 with debt of 170K. Yeah, not fun. Not fun. Okay? But if I'm 70 and I got 170,000 in debt, but I cash flow 5, 7, 10 grand a month, I almost don't care about the debt. You're cash flowing. Cash flow is the only thing that really matters in the 21st century. I just attended the 10X Growth Conference here in Miami, GrowthCon number 5. Every single billionaire on stage every single billionaire, there were all different cultures on stage that were billionaires. They all said the same thing: cash flow over everything. They said cash flow, cash flow, cash flow, and they said scale, expand, think big. So every billionaire, Kevin O'Leary, Damon John, Tommy Hilfiger, A-Rod, Grant Cardone, Glenn Stearns, Glenn Sanford, who else was there? Alex Rodriguez. There was another dude that was on there, owns real estate. I think Drew Brees might be a billionaire. Who knows? But he was there. So many billionaires showed up. I think Mike Rowe, I think he's a billionaire. Jesse Itzler, he's a billionaire. Nothing but billionaires. They all said the same thing: cash flow and scale. They didn't say anything about paying off debt. They didn't say anything about paying off debt. They all said cash flow, scale, think big, expand, serve, lead, help. Because we want to go from owing debt to owning debt. You want to own debt on planet Earth. The more debt you own, the more cash flow you're going to be able to create. You create a huge money-making machine. Okay? We are going to wrap it up here. This has been fantastic. Thank you for your time. I appreciate you. Click the links in the description below so that you can take your research further, evaluate me, get to know, like, and trust me, attend more live streams, jump on Clubhouse, okay? Get an iPhone, jump on Clubhouse, start networking, start building relationships, and I will see you on the other side. Enjoy the rest of your evening. God bless, and we will talk soon. I want to bring to you helpful tools and tips that you can use and implement in your life. So you have to define these words for yourself so you can understand how you can proceed in life in terms of making money. Work means becoming a king. That's what work means to me. But it's up to you to actually put in the work so you can see where you're at, what you're doing. This way you can see what you're up against and how to tackle it. Learn your purpose in life so that you can fulfill it and help others do the same. That's like my personal mission.